Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, January 30th, 2024. Hope everybody's having a fantastical day out there in the interwebs. It's another beautiful day here in Colorado. It is, what's the temperature right now? It's probably in the 50s, maybe. I can't see. It doesn't say. Anyways, yeah, it's probably in the 50s out here in Colorado. Lots of sun. There's still a ton of snow in my front yard where it doesn't get any sunlight. So it's like this high. I mean, you can walk up to the front path, but it's like snow, concrete, and then snow again. So anyways, if it is your first time watching Liberty Call, I'm glad you are here. Yes, you in the brown shirt. I see you right there. If you could do me a favor, if you can give me some thumbs up, likes, a share, a subscribe, a follow, and press that notification bell. All right, let's go ahead and get into today's news, starting out with the markets. Dow Jones was up 0.35%, about the only index that was doing good here domestically. Was up 133 points, closed at 38,467. The S&P 500 was flat, down 0.06, closed at 49.25. NASDAQ was down 0.76%, closed at 15,509. The VIX fell today 2.21%. It's down to 1330. Canada was up 0.13. Brazil was down 0.76, and Mexico was up 0.54. In Europe, Germany was up 0.18%. The UK was up 0.44%. France up 0.48%. Netherlands up 0.09%. Spain up 1.51%. Italy up 1.29%. Switzerland up 0.12%. And Portugal up 0.63%. Russian exchanges were split today. The MOEX up 0.56%. The RTSI down 0.32%. And the Asian markets, starting out with the Nikkei, it was flat, up 0.05%. Australia up 0.29%. New Zealand also up 0.05%. In China, the Shanghai was down 1.83%. Shenzhen Component down 2.4%. China A50 down 1.74%. DJ Shanghai down 1.91%. Hang Seng down 2.32%. Taiwan weighted down 0.4%. So I have to wonder if the Asian markets are, or especially the Chinese markets, are contaminated with the Everbank news I saw in the headlines yesterday. But we shall see what happens there. All right, let's go ahead and move over to the market recap for today. U.S. stocks waver ahead of big tech earnings. Fed meeting is kicking off. Everyone's on pins and needles. Well, I don't think anyone expects the Fed to do anything with rates right now. Probably the earliest would be the March meeting, which is March 19th and 20th. I'd actually put it probably the earliest at the April 30th, May 1st meeting, or the June 11th and 12th meeting. Personally, that's just me. My own personal, if I were to bet money on this, I would say that they're probably waiting for something unfortunate to happen. Like I've said many times, they like being the heroes, just lowering rates to lower rates. Is it going to do much? And we really don't know. All right, let's go ahead and get into the recap. U.S. stocks faced mixed movements on Tuesday as investors eagerly awaited earnings reports from major tech players Microsoft and Alphabet. Economic data revealed ongoing strength in the labor market, with the U.S. Labor Department's job openings and labor turnover survey indicating a rise in job openings to 9.03 million in December, surpassing economists' estimates. This positive labor market news followed a separate report showing consumer confidence reaching a 2-year high. Wow. Amid these signs of economic strength, 2-year Treasury yields climbed higher, reflecting investor expectation that the Federal Reserve would maintain its patient approach to interest rates. The Fed commenced its 2-day meeting, and while no rate changes were expected, analysts anticipate commentary emphasizing the need for ongoing patience with a balanced risk assessment. Tech giants Microsoft, Alphabet, and AMD initiated their earnings season for major tech companies after Tuesday's market close. These companies, along with Apple, Amazon, and Meta, collectively accounted for a significant portion of the S&P 500's 24% gain in 2023. If I could stop there, I saw an article, this was probably 3 or 4 months ago, that was talking about that. I think it's probably the Magnificent Seven. I think I referenced that yesterday. There's like 7 stocks, which have basically been all the gains of the market. And if you took those out, the market would look terrible. So, if you want to look into that, that's certainly some interesting data that, these tech giants are basically holding the market up, and what happens if they start to skid. In other tech-related news, Super Microcomputer experienced a more than 4% increase after reporting second quarter results that exceeded Wall Street estimates, driven by increased demand in the artificial intelligence sector. General Motors witnessed an 8% rise after stock rise after providing an optimistic outlook for 2024 and hinting at potential capital returns to shareholders. United Parcel Service faced a decline of over 7% following a lower than expected annual revenue forecast and plans to cut 12,000 jobs in response to sluggish domestic and international e-commerce demand. Pfizer, despite reporting a surprise quarterly profit, saw its stock drop over 1%, primarily due to weaker than expected sales of key products, including the new cancer drug, Ibrance. Yeah, stepping back to the UPS situation, it is a little surprising. I mean, yeah, they did get that huge raise. What was it, over the summertime, where their union really, boosted their income? Well, unfortunately, if they're out all that money, they gotta, make ends meet. And you got to balance the budget. So, somebody's got to get fired. That's just the way it is sometimes. All right, let's go ahead and move over to dive a little deeper into the job situation. U.S. job openings unexpectedly rise, but resignations are decreasing. In December, U.S. job openings unexpectedly increased, suggesting that the labor market remains robust and may deter the Federal Reserve from initiating interest rate cuts in the first quarter. Again, if you're holding out hope for interest rate cuts before the end of March, I would not hold my breath. The Labor Department's JOLTS report revealed a rise in job openings to 9.03 million, exceeding economists' expectations. The number of positions for every unemployed person held steady, indicating ongoing labor market strength. The Fed is expected to maintain unchanged rates at its two-day policy meeting against a backdrop of economic resilience. While the labor market is gradually cooling, Americans are staying at their current jobs, which could contribute to slower wage growth. The data indicated the lowest number of people quitting their jobs in nearly 3 years. Persistent demand for workers, although positive for economic growth, may pose challenges to cooling inflation early in 2024, complicating efforts to shift monetary policy easing. Again, why do we need to ease the monetary system? It's fine the way well, actually, it's not fine. There's way too much cash in the system, but lowering rates or printing money is not the solution. And actually, the money supply has started to increase again. So if you go and look at the Fred website, the Federal Reserve, I forget what the other part, but it's basically the St. Louis Fed. It's FRED, and do a Google search for Fred M2, and you can see how the money supply is starting to creep back up. The JOLTS report showed notable increases in job openings in sectors such as professional and business services, manufacturing, retail trade, healthcare, social assistance, and financial activities. However, unfilled jobs decreased in accommodation and food services and wholesale trade. Hiring rose, driven by professional and business services, accommodation and food services, and state and local government, while healthcare and social assistance hiring declined. The report also highlighted an 85,000 increase in layoffs, with United Parcel Service planning to cut 12,000 jobs. Resignations fell, led by healthcare and social assistance, indicating a positive sign for slower wage inflation. The relatively low quits rate bodes well for easing wage inflation and price pressures in the economy. Consumer confidence rose in January, reaching its highest level since December of 21. The Conference Board's Consumer Confidence Index increased to 114.8, with improvements across all age groups and income levels, except for households with incomes of $125,000 or more. Yeah, because we're getting kicked in the nuts with taxes. Consumers' inflation expectations for the next 12 months dropped to 5.2%, the lowest reading since March of 2020. Despite confidence gains, consumers were less enthusiastic about making big-ticket purchases in the next 6 months. The data also revealed solid house price growth in November amid a shortage of available properties for sale. All right, so there was something there I wanted to expand. Oh yeah, where is it? Yeah, the consumers making over 125,000. So, we're not feeling the shocks when it comes to the, like food and things like, it's still more expensive, but, when it comes to taxes, our property tax rates, things like that. My property taxes here in Colorado have almost doubled since we moved here 7 years ago. Again, I'm not complaining. The property taxes are quite reasonable here compared to Texas. If you live in a major metropolitan area in Houston or in Texas, your property taxes are just outrageous. So, it's kind of a give and take. I pay income tax, but I don't have to pay property tax. So it's one or the other. All right, let's get over to our last article here. I don't know if you've seen any news or articles that Paul Krugman, who everyone thinks is a genius, I think he's an idiot, but he was out there over the last few days saying that, the Fed has licked inflation and, everything is fine. This article basically is a counter to that. So it's titled Contra Krugman, Policies of Countering Unemployment Are Costly. See what this article has to say. All right. The article criticizes the idea supported by economists like Paul Krugman that government-funded employment programs can be a cost-free way to counter unemployment. It's not. The author argues that funding such programs through money printing is based on a misunderstanding of the nature of funding, which is rooted in real savings. Real savings representing unconsumed consumer goods, sustained individuals engaged in the production of goods. Money as a medium of exchange facilitates trade among producers, but is not real wealth. The author emphasizes that money itself cannot be consumed or used directly in the production process. The key point is that genuine economic growth is driven by real savings, which are used to fund the production of intermediate goods and consumer goods and services. The author challenges the notion that the government, unable to produce real wealth, can fund employment programs without diverting real savings from wealth generators. The inefficiency of government initiatives is highlighted as they do not contribute to the production of goods and services necessary for sustaining life. Yeah, they build rockets and missiles and planes that kill people. Additionally, the article disputes the idea that increasing demand through government-funded employment projects can lead to real economic growth. It doesn't. You're taking people like I grew up near NASA, and all those people there who are engineers and computer programmers and all that stuff. They, in my opinion, that's wasted productivity that they could have been in the private sector, developing new whatever, widgets, whatever it might be, as opposed to building things that are only used for the public sector and get blown up in space or get bombs dropped somewhere else. So it really aggravates me. Where were we? Government. It argues that genuine production expansion is constrained by the availability of real savings, which only wealth generators can set in motion. Government spending, far from creating real economic growth, is seen as diverting resources from wealth-generating activities and potentially undermining the wealth generation process. In conclusion, the article challenges the cost-free nature of government-funded employment programs, asserting that such initiatives based on money printing rely on a misunderstanding of funding rooted in real savings. The inefficiency of government initiatives is contributing to real economic growth is emphasized, and the diversion of resources from wealth generators is identified as a potential drawback. All right. So, and it's kind of like the same situation with GDP. I mean, everyone's been, slapping each other on the back saying, woo, GDP was at 3.3% for Q4. That's awesome. But how much of that GDP was actually from government-sponsored, missiles, defense, all that good stuff? Because we know that the government overspent by $750 billion per quarter. So of that $750 billion, how much of that, boosted or goosed the GDP for Q4 to get it to the high number that we're at? Because, we're printing money, or basically we're counterfeiting money and reducing the value of the dollars in your bank accounts to make the GDP look good and, have government spending, which, in the short term, it makes Boeing and Lockheed and Raytheon and all those companies happy. And their employees, they go out and spend that money in the economy. But, if they had been, working on, where's my flying car? I don't want an electric car. I want a flying car like the Jetsons. My dad watched the Jetsons when he was growing up. I bet he was expecting flying cars before now. And I'm 50 or I'll be 50 next month. So, anyways. All right. I'll get off my soapbox for now. So that is everything that I had for today. I hope everyone has a wonderful evening. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. Again, I hope you have a wonderful evening, and I shall talk to you next time. Adios.